Okay, chapter 7 of investments class. So we're going to talk about CAPM, the capital asset pricing model, and then arbitrage pricing theory as well. So the capital asset pricing model talks about the fact that securities' required rate of return relates to the systematic risk measured by beta. So this kind of goes back to what we talked about last chapter, where we're talking about the fact that there's an element of risk involved whenever we're investing, and generally speaking, the expectation would be an asset that returns better with the lowest amount of risk should be priced the highest. So the highest return for the least amount of risk is generally yielding the highest price. And then we also are going to talk about market portfolio. Market portfolio, so each, and when we talk about a market portfolio, we're talking about all of our securities being held in proportion to their market value. So there are several assumptions that we make based on this model, the CAPM model, the capital asset pricing model. And what's kind of interesting is these are all things that we kind of just take out for not necessarily for any reason, but to see purely what the market will do in effect. Because some of these things are obviously things that almost never happen, like, for example, no transaction cost. There's almost always some kind of transaction cost. So market assumptions: all investors are price takers, meaning they don't negotiate that. All information is relevant to security is free and publicly available. This is, that particular rule is where we derive things like insider trading from, where people are supposed to only make decisions on publicly available information. All securities are publicly owned and traded. No taxes on investment returns, which is also not the case. No transaction costs, and lending and borrowing at the same risk-free rate are unlimited. So effectively, we're looking at a perfect economic environment for trading stocks, where we've got no barriers, we've got no tax, we've got no barriers to lending and borrowing. The investor assumptions: the investors plan for the same single period horizon. Investors are efficient users of analytical methods, which means the investors have homogeneous expectations. And then investors are rational mean variance optimizers, like we talked about in the prior chapter. Okay, so the capital asset pricing model has a hypothetical equilibrium. And how that occurs is if all investors choose to hold a market portfolio, including all assets in the investable universe. So this would be holding a portfolio that contains some of all the assets, or all the assets in the investable universe. If the market portfolio is on the efficient frontier, that's from the prior chapter when we talk about that frontier element to the market, the efficient frontier. Whereas if it's a perfectly efficient market, then it moves along that line, or that graph that shows that's where efficiency resides when trading is efficient. The market portfolio is on the efficient frontier. It's an optimally risky portfolio. So only enough risk that they are required to have in order to have the maximum amount of gain. The risk premium on the market portfolio is proportional to the variance of market portfolio and investors' risk aversion. So we have the same amount of risk premium that we have risk aversion. So we're level in that regard. So that means that it basically says that people are almost always willing to buy, because there's a proportionate variance between what the premium that's being charged is and what investors' risks are not willing, and what they're not willing to take as far as risk goes. The risk premium on individual assets is proportional to the risk premium on the market portfolio and proportional to the beta coefficient of security on the market portfolio. I'm going to talk a little more about beta coefficients here in a second. So this is the efficient frontier capital market line. Should look familiar based on the graphs that we did in the last chapter. For where our efficient market capital line is. So if these things are all true, if these assumptions are true, and our hypothetical equilibrium that holds true, then we would assume that a passive strategy would be efficient. Things like mutual funds. So mutual fund theorem says all investors desire the same portfolio of risky assets and can be satisfied by a single mutual fund composed of that portfolio. If passive strategies is costless and efficient, why follow an active strategy? Well, the issue comes with if nobody's following an active strategy, then we can't ever reach that frontier, because that negates our assumption that individuals are making analytical decisions with analytical methods and have homogeneous expectations. So the issue, that's what issue right there, is we can't all have a passive strategy. You could have some people with a passive strategy and that would be okay. But if everybody were to adopt a passive strategy, the market wouldn't react in an efficient way, because no one was buying and trading based on information, public information gathered. So if no one does security analysis, what brings about the efficiency of that market portfolio? The risk premium of the market portfolio. Demand drives prices, lowers the expected rate of return premiums. So demand is where the prices come from. So people offering to buy something, demanding to buy something rather than the supply of something. When premiums fall, investors move funds into risk-free assets, so assets where they can have a return and have very little or no risk, risk-free, of losing their money or losing their investment. The equilibrium risk premium of the market portfolio is proportional to the risk of the market and the risk aversion of the average investor. So that's where those two lines that will cross. That's where our equilibrium will occur. Okay, the expected return on individual securities, the expected return beta relationship. So the implication of CAPM is that security risk premiums, expected asset returns, will be proportional to beta. So this beta is the numerical function that balances our risk, our risk premiums, and our expected excess returns. So effectively, the higher the beta, the higher the risk, and the higher the expected excess returns. That same thing would go the opposite direction. The lower the beta, the lower the risk, the lower the expected returns. A security market line. This is on page, this is on page 198 of your book. This is the graphical representation of the expected return beta relationship of CAPM. So this graphs the individual asset risk premiums as a function of the asset risk. So we're comparing how much risk is involved and how much we are charging for that risk. What's the risk premium being charged for the risk? And alpha is the abnormal rate of return on a security in excess of that predicted by the equilibrium model. So if I had a beta for a stock or for even a group of stocks, if it goes beyond that, if the return is beyond that, the difference, or how far beyond it has gone, is called the alpha, the abnormal rate of return. So here's my alpha right here. So that's my expected return is 15.6. So my alpha in this case would be this 1.4. And my beta was 1.0. Actually, it's 1.2. Excuse me, my beta is 1.2 in this case. All right, applications of CAPM. Use the SML, the security market line, as a benchmark for fair return on risky assets. So how much risk should I take how much risk do I need to take if I want a 10% return or a 15% return or a 20% return? Where's that balance at, and how can I figure out or calculate exactly what that risk is and how much I have to take in order to receive the benefits? So SML provides the hurdle rate for internal projects. So what effectively SML does is that if we're looking at certain projects and we can judge their riskiness within our organization, say expanding the business or buying new machinery or buying, expanding to a new geographical area, any of those things that are investments within the organization that definitely involve risk, the SML provides the hurdle rate that we would need to utilize to make a decision. So if my SML is 10%, and I know that my internal project can make me, or I calculate that my internal project can make me 15, then I've gotten over that hurdle amount and I'm wanting to invest in the internal project versus investing in the market or the external project. Where if the opposite is true, if my SML, let's keep it at 10%, but I do the crunch numbers on my internal project, again, things like building factories or expanding the business or expanding geographic markets is lower, the return is lower, what the hurdle rate is, then I'm going to want to take that money and do something else with it, generally invest in probably securities, what we're talking about here. rather than invest it in internally in the organization because I'm not making as much. So index model realized the mean beta equation. So RIT is the holding period return, where I is the assets and T is the period. And then we have our alpha. Alpha intercept is the intercept of the security characteristic line. Our beta is the slope of the security line. We have our alpha and our beta. And on a return index for a given period, so return index for a given period, and then the firm specific effects are out here. So estimating our index model. The residual is the difference between our actual return minus our predicted return. So residual income would be if I earn beyond what is expected. That would be the residual earnings, and would also be known as the alpha in this case. Okay. The security characteristic line. The plot of the security expected return and excess return over the risk-free rate is a function of the excess return for the market. So the required rate equals the risk-free rate plus the beta times the expected excess return. So we're requiring that we at least earn obviously more than the risk-free rate, as well as whatever the beta, which is my risk analysis model, okay, which comes in my risk analysis element, times what the expected excess return of the index is. All right, and then predicting betas. We do that with mean reversion. One second here. Okay, so predicting betas, we use our mean reversion, meaning that betas move towards the mean over time. So while they might be a number greater than the mean to begin with, 1.0, by the way, would be the mean of betas, because that would mean you're reacting, if it's a beta for the index market, then that means you're reacting exactly the same. So we predict future betas and adjust the estimates from historical data to account for the regression towards 1.0. 1.0 is the mean, because a 1.0 beta means that it moves exactly with the expected return and exactly with generally the indexes. CAPM is false based on the validity of its assumptions. So here's the thing, I kind of said up front that CAPM, while it's an interesting thought, and it is something that's important that you do need to learn, because of how many assumptions are made, because there's some assumptions that are kind of just out there, like no transaction, no tax implications, and some of those things that just aren't going to be the case. It's more like a model that you can utilize to, take a guess, but it's certainly not going to be perfect. It's a useful predictor of expected returns. It's untestable as a theory. Why is it untestable as a theory? Because those assumptions are not true, and there's not a place where those assumptions are true. Principles are still valid. Investors should diversify, and systematic risk is the risk that matters. A well-diversified risky portfolio can be suitable for a wide range of investors. All right, I'm going to stop this video here and continue chapter 7 in the next video.